Wall Street, the heart of the global financial system, is no stranger to volatility. The bustling trading floors and the constant hum of activity are a testament to the ever-changing nature of the markets. The year 2025 has brought a new wave of uncertainty and fear, pushing the markets to the brink. With geopolitical tensions rising and economic indicators fluctuating wildly, investors are on edge. As investors grapple with escalating trade wars, the specter of circuit breakers looms large. These mechanisms are designed to provide a pause in trading, allowing the market to catch its breath. These market safeguards, designed to halt trading during extreme downturns, have become a topic of intense debate. Some see them as essential tools to prevent panic, while others view them as artificial constraints. Circuit breakers were introduced after the Black Monday crash of 1987. This catastrophic event saw the Dow Jones Industrial Average plummet by over 20% in a single day. The crash exposed the vulnerabilities of a highly interconnected and technology-driven market. It highlighted the need for mechanisms to prevent such rapid and uncontrolled declines. Circuit breakers were implemented to prevent a repeat of such a catastrophic event. They act as a safety net, designed to stop trading temporarily and give the market a chance to stabilize. The idea behind circuit breakers is simple: to provide a cooling-off period during periods of extreme market volatility. This pause allows traders to reassess their positions and make more rational decisions. When triggered, they halt trading for a predetermined amount of time, giving investors a chance to digest information and make more informed decisions. This can help to prevent knee-jerk reactions that could exacerbate market declines. However, circuit breakers are not without their critics. Some argue that these pauses can create a false sense of security and may lead to increased volatility once trading resumes. Some argue that they interfere with the natural flow of the market and can actually exacerbate volatility. The debate continues as to whether circuit breakers are a necessary safeguard or an impediment to free market dynamics. The year 2025 has been tumultuous for the global economy, marked by escalating trade tensions and unsettling market shocks. The catalyst is a series of tit-for-tat tariffs imposed by the United States and China. These tariffs have disrupted supply chains and dampened business confidence. The stock market has reacted sharply to the escalating trade war. The Dow Jones Industrial Average has experienced several steep drops, wiping out trillions of dollars in market value. The technology sector, a driving force behind the long bull market, has been particularly hard hit. The recent market turmoil has reignited the debate about circuit breakers and their role in protecting investors from catastrophic losses. Circuit breakers function as emergency brakes for Wall Street. These mechanisms are crucial in maintaining market stability during times of extreme volatility. They are triggered when the market experiences a sharp and rapid decline, halting trading for a predetermined amount of time. This temporary pause is designed to prevent panic selling and give investors a moment to reassess their positions. This pause allows investors to catch their breath and assess the situation. It provides a crucial window for market participants to digest information and make more informed decisions. There are 3 levels of circuit breakers, each triggered by a progressively steeper drop in the S&P 500. These levels are designed to address varying degrees of market stress. Level 1. A 7% drop triggers a 15-minute trading halt. This initial level aims to curb the initial wave of panic selling. Level 2. A 13% drop triggers another 15-minute trading halt. This second level is meant to provide additional time for the market to stabilize. Level 3. A 20% drop halts trading for the rest of the day. This final level is a last resort to prevent a market freefall. The thresholds for triggering circuit breakers are calculated daily, based on the previous day's closing price of the S&P 500. This ensures that the circuit breakers are relevant to current market conditions. While circuit breakers are designed to prevent a repeat of Black Monday, their effectiveness in calming volatile markets is still debated. Some argue that they provide necessary breathing room, while others believe they may exacerbate panic once trading resumes. The recent market turmoil has left investors and analysts scrambling to make sense of the chaos. Expert opinions on the severity of the situation and the potential for a full-blown market crash vary widely. Some experts believe that the market correction is a long overdue adjustment to years of exuberance. They point to low unemployment, rising corporate profits, and strong consumer spending as evidence that the economy is not headed for a recession. Other experts are more cautious, warning that the escalating trade war poses a significant threat to global economic growth. They argue that tariffs are already disrupting supply chains, raising prices for consumers, and dampening business investment. Adding to the uncertainty is the Federal Reserve's monetary policy. The trade war between the United States and China has sent shockwaves through the global financial system. Tariffs have become a weapon of choice in the ongoing dispute, disrupting supply chains and raising prices for consumers. The European Union, caught in the crossfire, has been forced to navigate a delicate balancing act. The EU relies on both the United States and China for crucial imports and exports. The escalating trade war threatens to undermine the EU's fragile economic recovery. Emerging markets, heavily reliant on exports to China and the United States, have also been hit hard. The International Monetary Fund has warned that the escalating trade war could trigger a wave of debt crises in emerging markets. While escalating tariffs have taken center stage, it's crucial to acknowledge other significant economic factors contributing to this volatility. One such factor is the rise in interest rates. Central banks globally, including the U.S. Federal Reserve, began raising rates in 2023 to combat inflation. This shift increases borrowing costs for businesses and consumers, potentially slowing economic growth. Another contributing factor is geopolitical instability. Beyond the US-China trade war, global tensions remain high in various regions. The ongoing conflict in Ukraine and rising tensions in the South China Sea all contribute to a climate of uncertainty. Furthermore, supply chain disruptions continue to impact global trade and contribute to inflation. As the specter of circuit breakers looms over Wall Street, many investors and analysts are on edge, constantly monitoring the markets for signs of extreme volatility. Circuit breakers, while effective in halting trading to prevent panic selling, can sometimes exacerbate the situation by creating a sudden stop in market activity. An alternative solution to managing market volatility has gained traction: trading curves. This innovative approach aims to provide a more nuanced method of controlling market fluctuations. Unlike circuit breakers, which halt trading altogether and can lead to a buildup of unexecuted orders, trading curves offer a more flexible solution. Trading curves aim to smooth out sharp price movements by adjusting the speed of trading based on market conditions. This means that during times of high volatility, the system would automatically slow down the rate at which trades are executed. Imagine a highway with a speed limit that adjusts based on traffic flow. When traffic is heavy, the speed limit is reduced to prevent accidents and ensure a steady flow of vehicles. During rush hour, the speed limit lowers to maintain a steady flow of traffic and prevent accidents. Similarly, trading curves would dynamically adjust the pace of trading based on market volatility. By slowing down the rate of order execution during periods of high volatility, trading curves aim to create a more orderly market environment. During periods of high volatility, trading curves would slow down the rate at which orders are filled. This controlled deceleration would give investors time to digest information and make more rational decisions, rather than reacting impulsively to sudden market movements. This controlled deceleration would give investors time to digest information and make more rational decisions. Proponents argue that this approach offers several advantages over circuit breakers. By providing a more gradual adjustment to trading speeds, trading curves can help maintain market liquidity and reduce the likelihood of sudden disruptive halts in trading. This could lead to a more stable and predictable market environment, benefiting both investors and the broader financial system. As 2025 unfolds, the question of whether circuit breakers will be triggered remains a topic of intense speculation. The answer hinges on a complex interplay of factors, including the trajectory of the US-China trade war and the Federal Reserve's monetary policy decisions. If trade tensions escalate further, the likelihood of circuit breakers being triggered increases significantly. However, if cooler heads prevail and the trade war de-escalates, the market may stabilize, rendering circuit breakers unnecessary. The future of Wall Street in 2025 remains uncertain. The year 2025 has presented investors with a turbulent and unpredictable market environment. Escalating trade tensions, rising interest rates, and geopolitical instability have all contributed to a climate of fear and uncertainty. While circuit breakers remain a possibility, their necessity will depend on a multitude of factors. In this environment, it's more important than ever for investors to stay informed and avoid making rash decisions. Diversification remains crucial in mitigating risk. Investors should consider adjusting their portfolios to reflect their risk tolerance and investment timeframe. By staying informed and seeking professional guidance, investors can weather the storm and emerge from this period of uncertainty with their financial goals intact.